Well, let's welcome in Amish Shah. He's head of India research at BofA Securities. Amish joins us from the sidelines of the BofA Securities 2025 India Conference. Amish, good morning. Great to have you here. Prashant this side. We spoke to you when the conference was starting, so let's do a little bit of then and now. Although the then and now are only separated by 3 days. So what are the one or two things which really stood out to you from the conference in terms of takeaways from all the conversations you've had? And sort of made you sit up and take note of in terms of what was happening?
Sure. Good morning. Thank you, Prashant. So look, I guess there is definitely optimism within, across all sectors, amongst all companies. But at the same time, they are quite measured. So I think the message that we've got is that everybody's cautiously optimistic. The other trend that we've picked up is a majority of the companies are talking about how there might be a slow start to the first half of this fiscal, but most of them are expecting it to accelerate in the second half as we go along. So sector after sector, we heard it from IT, we heard that from consumer, from autos, from banks. So I guess the mood is that once the geopolitical and global macro issues get more clarity, there will be more growth visibility as we go along in the second half.
All right. Hi, Amish. Good morning and good to see you, Ben. What about, the biggest concerns with regard to the Indian markets? Flows seem to be good. Earnings are yet to catch up. But if you could highlight, a couple of concerns that your interactions with a lot of the investment community did throw up.
So, Nigel, I think the concern is that versus what the companies have already guided, at the margin, the tone is getting a bit more cautious or companies are highlighting more risk factors or factors that they are watching out before the companies themselves get clarity. I'll give you some examples. So auto companies, for instance, are talking about rural markets recovering, but at the same time, growth in the urban markets peaking off. If you talk to IT companies, they are talking about, slightly better than what they expected in terms of spends on cost takeout programs. So they are getting more deals, but yet they believe that till the time US-China trade issues are not sorted, their customers in the US are not able to make the full tech budget decisions because US-China trade deal is absolutely an indicator that the trade wars are behind us. So IT is waiting out for that. Banks, they know that the NIMs will compress on the back of rate cuts that are going through. And loan growth generally is not that, June quarter is not the best quarter for loan growth. So they're expecting an acceleration. But do you grow in unsecured, where there could be pain points in terms of NPAs later? If you try to grow in secured category, the NIMs are quite low in terms of mortgages, etc. So I guess, even the corporates are right now trying to figure out, on absolute all factors. They don't have clarity on all factors right now. So there is a bound of this cautiousness that they are highlighting, which is also keeping the investors a bit confused on whether should you go whole hog or do you wait out for the clarity to emerge. So I guess those are at the margin some concerns right now.
On the banking space, that's going to be interesting because everyone's waiting for a rate cut. But in the near term, actually, rate cuts will put pressure on the margins. And as you said, the loan growth is still being quite anemic. Are investors prepared to look ahead? Because as things progress, the first hit comes on the loan rates. And later on, in fact, the deposit rates as well will cool off. So ultimately, the NIMs will look good in the longer duration. In the near term, in fact, there'll be that headwind. Are investors willing to look ahead? And suddenly, in the last month or so, these PSU banks, they have come back into play. Is there a lot of interest for PSU banking names?
So Nigel, first of all, financials is at least a sector that unanimously everybody likes, including us. But then the answer to your question really depends on my investment horizon. So if I'm an investor who's mostly a hedge fund and cares for near-term triggers, they are not that excited about financials as of now because they do think that loan growth revival will take some time, but the NIM compression will be in the here and now. So you're first looking at a downprint and then you're going to look at an acceleration. But the long only investors are basically waiting if there were a correction on the back of that, because they want to, as you said, they want to look ahead and they want to use this dip as a buying opportunity. In context of the banks within private and SOEs, etc., I would say that again, that depends on how much risk you want to add to your portfolio. So if I'm an investor who's happy with steady returns but a safe stock, then I still want to be invested in the top 2 or 3 private sector banks. But obviously, if I want to add beta to my portfolio and I don't mind taking a little bit of more risk, but I want higher returns, then SOE banks are definitely finding favor because there at least valuations for SOE banks, as we know, is quite cheap. A lot of them are still trading below 1-time book. So the expectation is that when the cycle turns, it will be favorable for all banks, and cheaper banks should therefore give you higher returns.
No, absolutely. Amish, there are so many, in a way, and India, the beautiful thing about, of course, the market here is it's not concentrated in one segment, right? And I think that's a point that you've made before as well. And global investors appreciate it's not metals heavy or tech heavy like many of the regional markets are. So you really have a buffet of stuff and a big one. But incrementally, I'm keeping aside some of the older legacy sectors, which are the sort of newer areas where investors are really looking for ideas in. And in these new areas, there are lots of sort of companies making it to the market with IPOs, etc. as well. So just give us a tease about that, 2, 3 sort of newer segments in that sense.
So Prashant, actually there are plenty. You're very right. India clearly has a lot of opportunities, and a lot of interesting companies are now getting listed in a variety of sectors that we were earlier not looking for. So I think valuations aside, but sectors that really excite investors right now is EMS, semiconductors, biofuels, green hydrogen, data centers, travel and tourism. So clearly there is a variety of things to choose from. In fact, even in the consumer durable space, there are some interesting listings that are expected. So that space is expected to go wider. Every time that you hear about an industry body talk about manufacturing, electronics is only expanding as an ecosystem. It started with mobiles. Now it's being expected that it will roll over to consumer durables, and it is expected to go to tech hardware, and then semiconductors comes in by that time, gives you visibility. So there is definitely traction to all of these themes. In some cases, valuations though may not be to your comfort.
Okay, all right. Amish, post this run that we have seen, and when we went to around the 22,000 mark, you all were quite positive. Now, do you think for the remainder of this year, fixed investment bonds, they will offer better returns in comparison to the Indian headline equity market?
I would say so, Nigel. On a fixed income product, you can make about 7% pre-tax, but that is definitely in the bag. Whereas for the Nifty, as you know, our target for this year is 25,000. We are only about a percentage away from there. So clearly the conviction that markets could give me even a high single-digit return is not very high. So if I can get a safer return in a fixed income product, then I would probably look to avoid the risk of equities right now. And when I go to the broader markets, there, as you know, our views have been negative because we think that large caps are still sensibly priced or fairly priced, but the mid caps are actually quite excessively priced. So I would say that if you're a patient investor, you may want to step aside, get into fixed income for some time, look for markets to get cheaper, and then equities, obviously, in India from a long-term perspective, is definitely going to outperform debt over long term.
Okay. All right.
No, absolutely. And I think those are important points there that you make. Amish, thank you very much for joining us. It's a pleasure having you here on CNBC TV 18, and look forward to our next conversation. Thanks indeed. So that is Amish from the sidelines of the BofA Securities 2025 India Conference.